in 2008, or maybe you want to go further back than that, when you're working at the US Treasury and the economic collapse happens, what was that like being part of that? And what lessons did you take from that?
Yeah, so chapter one was me back in the swamp. Spent 8 years in Washington, and I bounced around between the Treasury, as you say, the State Department, and the White House. Those were three areas that were of keen interest to me. And all of my roles had to do with the intersection of economic policy and national security policy. So I was very much exposed to issues like counterterrorism finance in 2004 and 5 as we were hot on the trail of the bad guys, and then targeted sanctions programs as we were concerned about rogue states. And by 2008, I ended up inside the Treasury building for what I thought would be a nice, sleepy end to my Washington experience. And little did I know I was stepping into this complete firestorm. And I ended up spending just shy of 3 years working on a handful of the rescue programs, including this public-private investment program. Every good government rescue program needs an acronym. So the one we worked on was called PPIP, focused on legacy securities. And that was really the toxic assets, the commercial and residential mortgage-backed security markets that had completely frozen. Those were the assets that were clogging bank balance sheets. That was what TARP was designed to do. And the Paulson team actually didn't have enough time to implement those components of the rescue program. And so they went with direct capital injections to major financial institutions. But when the Geithner team came in, they wanted to address the fundamental issues since things had started to stabilize. And I got to work on that. And so the takeaway from that first chapter was very straightforward. The system we had and the system we have is far from perfect. There are plenty of fault lines built into the formal financial system. And if 2008 wasn't concerning enough, we have that resurfacing in 2023 because all of a sudden a spotlight is shining on the very banks that you and I do business with. This idea around uninsured deposits. What do you mean my deposits may not be safe? I'm aware that there was a $250,000 limit. And for most people, that is plenty of headroom, but not for small businesses. Small businesses aren't keeping the excess cash above $250,000 that they require to operate under the counter and dishing it out as they need. They keep plenty of money in these institutions, and often they rely on their local or regional banks, not just the big money center guys, not just JPM and Citi, Wells, and others. So those were some of the takeaways and part of what had inspired me to at least have an open mind to what alternatives might exist. And the alternatives should ease some of the pain points when we look at financial transactions.